Good afternoon, everyone. This is Kathy Neifeld. We are expecting a large crowd, and we know that there's a lot more people that are trying to dial in. So we are going to start this at 4:02. So you've got 120 seconds to answer a couple more emails or get a beverage. So we will see you back at 4:02. Thank you. Okay, here we go. Good afternoon. For those of you that do not know me, I'm Kathy Neifeld, one of the 4 principals at AgencyONE. Along with my partners, Ed Lesher, Dennis Bartos, and Gonzalo Garcia, we are pleased to welcome everyone to the 4th installment of AgencyONE's 2021 bi-weekly webinar series. Since the beginning of the year, we have had webinars on estate, income and gift tax planning and asset protection under the new Democratic administration, featuring attorney Alan Brown and advanced markets consultant Randy Zipsey, a webinar on changes to Internal Revenue Code section 7702 and the impact that these changes will likely have on permanent life insurance products with Bobby Samuelson, and also a webinar on digital marketing tools and resources and strategies that you should be using to help drive more business with Samantha Russell. Most of these webinars have been recorded and are on our YouTube channel and also on the AgencyONE website for your convenience. Today's webinar will focus on premium financing with US Bank, and this webinar is being recorded. For those of you that are new to AgencyONE, a brief introduction. We are a very high-touch, exclusive brokerage general agency. Exclusive, what does that mean? We have a platform called the AgencyONE 100, and one of our guiding principles is to work with a small, select group of advisors in a very large way. The advisors that are part of this group are like-minded, highly successful, creative, and driven. We focus on life insurance and annuities. If you have other needs like disability or life settlements or standalone long-term care insurance, we have strategic relationships with the best providers in the industry to refer you to. We truly have the premier underwriting department in the industry, led by my partner Dennis Bartos, and advanced markets and case design departments led by my partner Gonzalo Garcia. If you want high-touch, personalized attention, advocacy, and want to feel like you and your cases are important, then AgencyONE is or should be your BGA. If you would like to learn more about us, the AgencyONE 100 platform, and how you can become part of it, or if you have a case that you would like to discuss, please reach out to me or Gonzalo or Dennis or Ed. I have some additional important announcements about what AgencyONE has planned for the next few weeks, and I will be sharing them with you at the end of the webinar. Now I would like to introduce our speaker for today's session, Taylor Miller. Taylor is the National Director of Insurance Premium Financing for US Bank. He is responsible for all aspects of insurance premium financing lending across the US Bank Wealth Management Division. He leads a premium financing team that are responsible for working with insurance professionals nationwide on all aspects of a premium financing transaction, from initial introduction through ongoing relationship management. Taylor also leads his team in negotiating lending terms, including loan approval and closing, ongoing monitoring of the portfolio, as well as credit reviews and renewals of U.S. Bank insurance premium financing relationships. Taylor has been in the banking and financial services industry since 1990. Taylor will try to respond to any questions that have been asked at the end of the presentation, so please submit your questions through the question feature, and we will be monitoring them as they are submitted. I will now turn the session over to Taylor.
Good afternoon, everyone, and thank you, Kathy, and thank you, Gonzalo, for having me. It's fantastic to be with you and with the group that you've assembled here, and knowing you and your business like I do, I can only imagine the intellectual capital and intellectual talent that is on a part of this webinar. So thank you very much for hosting me. And so I hope all of you can see my screen, and the first thing you see there is the AgencyONE logo. And for those of you who may be calling in from the Midwest, I didn't realize that the AgencyONE logo was really a picture of about how it has felt here the last several days. So I happen to sit in Kansas City, and today it's about 20 degrees, which feels like a heat wave compared to how it's been lately. So I'm pleased to be with you all. And by the way, if you look very closely at the top of that mountain, I think you'll see Ed Lesher and Kathy Neifeld at the top waving at you. I happen to know that they've climbed mountains literally before. So that's a pretty cool logo that they have there. So what I'm going to do today is I'm going to talk with you all about insurance premium finance, and I'm going to talk to you about U.S. Bank's place in the insurance premium finance marketplace. It's a pretty diverse field, a pretty diverse offering that lots of banks do have, and I want to talk to you about what U.S. Bank does. And I want to start at the maybe at the 100,000 foot level, and we're going to work our way down to ground level, and then we're going to really drill down. So as Kathy said, if you have questions, please submit them, and I'm going to save time at the end of the discussion to answer any questions that you might have or cover anything that maybe I've left out that is important to you. So don't hesitate to reach out with the questions during this section. So as Kathy said, I'm fortunate to be a part of the national team that does insurance premium financing for U.S. Bank, and as such, we are a part of the the wealth management arm of U.S. Bank, and we got our start in premium finance lending just about 10 years ago. And I will tell you this, you probably already know if you're a part of this call or listening to this call, that the group at AgencyONE, when U.S. Bank first had the idea of getting into premium finance lending, AgencyONE was literally, and I'm not exaggerating, I'm not making this up, and this is not a paid commercial endorsement because I'm with the AgencyONE webinar right now, the first group that we reached out to as we were exploring this and whether or not it made sense for our bank to do was the AgencyONE team. We jumped on an airplane from Kansas City, where I live, and we flew to Maryland to meet with Ed and with Gonzalo and with Kathy to talk about this, and Dennis Bartos as well. So the reason that I tell you that story is because if premium finance is new to you, or you're not sure, if it has an application for what you do, the AgencyONE team are the experts you want to be paired with. And as I said, I'm not getting paid to say this. I'm not getting paid to do this webinar. I just want you to know how we view them here at U.S. Bank. And I'm going to tell you just a little bit about U.S. Bank. For those of you maybe who are on the East Coast, we don't have a lot of bricks and mortar locations, but we're a nationwide bank. We're the 5th largest commercial bank in the United States, and our premium finance team that I'm fortunate to be a part of makes every premium finance loan that we do in our bank comes across my desk. And our place, our swim lane in this space, if you will, is that we are designed for high net worth and ultra high net worth borrowers who are looking to effect a wealth and estate transfer through the use of financed life insurance premiums. And so as a result of that, and we're going to get into this about loan amounts, interest rates, all of that kind of thing. So as a result of that, we have built a portfolio over the last several years in this space that is about $1.5 billion of outstanding loans. And in 2018, we actually formed a centralized national team that does nothing but premium finance all day, every day. And what I mean by that is the teammates that I work with every single day are all bankers who were private bankers in our wealth management space, and we all moved over and started this team officially in 2018. That was after doing the making premium finance loans for several years in a decentralized way. But we realized that this business is extremely important to U.S. Bank, and as such, it needed a team that was dedicated to it. And a lot of banks in the space don't approach the business that way. They have a more decentralized approach where they have their private bankers or bankers doing premium finance. But I'm pleased to tell you that this is all that we do every day, all day. Our credit analysts, our credit approvers, our bankers, our associates. This is it. This is our day job, and I'm pleased to be a part of this. So I'm not going to spend a lot more time talking about U.S. Bank specifically. I want to start talking about what premium finance is and how it can help you, because really at the end of the day, premium finance is a way to pay large life insurance premiums and help you close larger cases. So when you're out in the marketplace and you're looking for clients that have those high net worth clients who have a need for life insurance, but they're not quite sure how to pay for it, whether they can write a check or should write a check for those large premiums, a premium finance loan is a way to merely pay for that. And we're going to talk about what premium finance is and what it is not here in just a moment. So let's talk about that right now. So as you can see on your screen right there, let's just start with the basics, right? What is premium finance? It is a part of a well-rounded estate plan. It is not the only piece of an estate plan. Think about it. So large life insurance policies are being purchased by your clients, and that's not the only piece of their estate plan, right? So therefore, they're not building their net worth around a life insurance policy. The types of insurance policies that we finance at U.S. Bank are just what I said earlier, and that is a part of a wealth and estate transfer strategy where large life insurance policies are being purchased, and we are providing financing as a means to help pay for that. So what it takes is, and we're going to get into this a little bit more in a few slides as well, what it takes is a qualified buyer, qualified insured, qualified borrower, and these can also be used to help provide liquidity for the clients who don't want to see their assets all go to Uncle Sam upon their demise, or they don't want to fire sale their assets in a distress situation when they pass away. Think about this when you're thinking about which clients you can approach. I will give you some characteristics of the U.S. Bank portfolio that I think are pretty common to premium finance across all banks, but at least with the U.S. Bank portfolio, I would tell you that if I could take all of our clients and generalize about what they do and where they come from, I would characterize them in three ways. Number one is very liquid clients, very large, very wealthy clients who could write a check for very large life insurance premiums and not miss the money at all, but they recognize the value of using leverage to keep their money doing whatever it is that it happens to be doing for them right now, keeping it invested and earning the returns that they are, or not wanting to take funds. Maybe they have low basis assets and they don't want to liquidate them to pay premiums. Leverage using life insurance premium finance is a way to do that. The second group that we work very frequently with are privately held business owners. Think about your clients and your prospects who are privately held business owners, where they've spent a lifetime building a family business, a privately owned business, where it could be a manufacturing business, a service business. The type of business is really irrelevant, but what they've done is they've amassed a large net worth over time. And if they were to pass away, they're going to have to pay those estate taxes, but maybe the only way they could raise cash to pay those estate taxes would be to sell that business, which is obviously not advantageous to them and their family maybe after they're gone. And then the third group of people that we deal with frequently are commercial real estate professionals. So think about your commercial real estate clients and prospects that have, again, massive net worths, but maybe not a lot of liquidity, because what we see oftentimes with commercial real estate professionals are they have these big net worths, and when they sell a property or sell a building or build a building and they have a windfall, they go right to the next deal. And so they're constantly, what we talk about that as the velocity of their funds, right? Their funds are always in movement into the next deal that can make them 20 or 30% over time. So, but they're not, because they are keeping their money in motion, they're not necessarily putting money on the sidelines to pay large life insurance premiums. And by the way, for U.S. Bank, given that we're in that high net worth and ultra high net worth segment, the minimum annual premium that U.S. Bank does for our loans, the minimum is $1 million a year or more. And I want to clarify that. I don't mean $200,000 a year for 5 years. What I mean is $1 million a year per year. And normally we see those on a 5, a 7, or a 10 pay, and then the premiums are finished. And if I get asked frequently, do you have a minimum net worth for your borrowers? And the answer is no, we don't. We don't have a minimum net worth, but if you think about it, and some of this depends on the age and the health of the insured, that person, if they're paying between $5 and $10 million at least over the life of their payment schedule, if they're paying between $5 and $10 million over the life of that schedule, they're probably buying $20, $30, $40 million worth of life insurance. And of course, I think we would all agree that on the horizon, there will be a larger need for more and more of our prospects to buy large life insurance policies, because there will probably be, and this is not a political statement at all, there will probably be changes to the estate laws over time. And I don't think anyone thinks they're going to be more friendly to the wealthy than they are now. That most people probably would tell you, the prognosticators would tell you, they're more likely to be, they're going to start lowering exemptions and family exemptions and individual exemptions. So that's why, again, premium finance discussion now is a good thing to be hearing and thinking about. So also you see on the screen, what premium finance is not. And this is important to point out. These things that you see on here are really important to think about as you're working with your clients and with your prospects. So I would say that it's not a means to sell more insurance, meaning that it's, if somebody borrows money and pays interest on their loans instead of writing large checks, that maybe they should get more insurance than they might otherwise need. I don't need to tell this audience, about the suitability of insurance and tailoring that to fit what your clients need. And by the way, that's what we do here at U.S. Bank. Every deal that we do is a custom solution. It's not a check the box, fill in, and just fill in, follow a recipe. It's very custom to that client and to that family, because while our clients have common characteristics about their need for borrowing, and typically the common characteristics are that they're wealthy and they want to provide means to protect assets after they're gone. How they got their wealth, or how they amass their wealth, or what they intend to do with their wealth after they're gone, that's a very personal decision, and therefore they should have a very personalized lending solution for them as well. So I'll just say this and move on. It's not a means merely to sell more insurance. This premium financing is not a solution where what we're doing is we are providing the financing for a large life insurance policy, and that's the only asset that they have to protect. This is designed for individuals and families who do have an estate that needs to be protected. And this is the next point is really important also, and something to think about, and that is premium finance is not a strategy where the only source of repayment for the loan is the death of the insured. Okay, that's a foundational piece of U.S. Bank's premium finance offering. And what I mean by that is that we will not approve a loan, and I don't think most banks would either, but I know that U.S. Bank would not approve a loan where the only way that the loan could be repaid is that the client must die, and then we take the life insurance proceeds. That's not That's not sound underwriting and not a loan that U.S. Bank would approve. And you might say, okay, well, what kinds of loans would U.S. Bank approve? And we're going to talk more about that, but
Hey,
I'll
Taylor.
mention it here. Yes.
Taylor, it's Kathy. Let me just ask you a quick question, and this ties in with a question that one of our audience members has posed, who typed it into the question box. You talked about the candidates that are good or are, favorable candidates for a premium financing transaction. And you had listed, very liquid, a large client. They understand the value of leverage. And you also had mentioned clients that have commercial real estate. So a client that, is liquid and understands leverage or has real estate, it's a two-part process. You've got a client that, ultimately has the net worth and has the ability, as you say, to pay the premiums. But the second part of the equation is the collateral that is required for the loan. And you haven't gotten there yet, but when you've got clients that are in real estate and have everything, have all of their money tied up in real estate, what kind of collateral is acceptable? Because that's always a question for the clients that are real estate rich and cash poor, which ties into the question that was asked by the advisor, which was our large farm businesses prospects. So can you focus on the collateral aspects when you're talking about who qualifies, because it kind of goes hand in hand regarding what they can actually post?
You bet I will. I'll spend a little bit more time in depth talking about that when we get into our case study here in just a moment. So,
okay.
But to answer the question directly, are farmers and ranchers good prospects for premium financing? The answer is absolutely. One of the best deals that we've closed so far this year was to a large ranch operation out of Nebraska, where he had a lot of what they call rolling stock, right? A lot of farm machinery and equipment and a lot of real estate and a big estate to protect. Not a lot of debt. I mean, the family had done very, very well over time, but they needed a solution to help, and so we were able to tailor something for them. And I'm going to talk about that, because you're right. With commercial real estate professionals, you do have to have some liquidity to do this. Okay, it doesn't mean that you have no liquidity. You have to have some, and we'll talk about what that looks like. So, and then I'm going to make one more point, and then I'm going to move on to the next slide, and that is insurance premium finance is not. If there's one thing I would want to leave you with today, it is not merely and only an interest rate arbitrage. Okay, like I will tell you right now, the arbitrage opportunities are fantastic, but none of us can predict where rates will be in the next 5, 10, or 20 years. And the expectation is when a client does a premium finance loan, that he or she or the family will be involved with it for 5 or 10 or 20 years. It's a long-term play. It's not a quick in and a quick out. So if the only way that a case could work is that there's positive interest rate arbitrage, I would tell you, you should think twice about that. There will be times where, the performance of the policy may not be what you're looking for at a time where interest rates rise. You have to be able to weather that. So, and we're going to talk about that, about the stress testing that goes on to show those types of outcomes here in just a minute. So again, I'm not going to spend a lot of time on this slide here, but again, I think I've touched on most of this already. So, what you're looking for, the type of client you're looking for is they understand the use of leverage, to pledge collateral versus writing large checks, to pay interest instead of paying a large premium. And this is important here, that they are financially able to make premium payments if, for whatever reason, in their judgment, financing becomes unfavorable. Say interest rates do rise and they don't want to pay more, they don't want to pay a higher interest rate and they want to just pay their premiums. They need to be able to do that to keep that policy in place. One of the things I mentioned, the foundational piece, was the ability to repay the loan. And right hand in hand with that at U.S. Bank, and I think most banks would agree with this as well, that premium finance is not, and I underscore, is not a free insurance program. Okay, the clients need to be engaged. They will be pledging collateral. They will be paying interest, There has to be, some skin in the game, as they say, and that if the whole thing is designed so that they borrow the premiums and they borrow their interest and they never put any money of their own into the deal, those are the kinds of deals, and I'm going to show you this in our case studies, that over time can become problematic. So it's important to think about that when you're approaching your prospects and your clients about premium finance, that it's not a free insurance program at all. And this is an important piece of premium finance, and that is there's a lot of due diligence and a lot of stress testing that goes into underwriting one of these loans, because when U.S. Bank makes one of these loans, we recognize that this is a big piece of the estate, the overall estate plan for the client. It's not the only piece. Obviously, they're trying to protect assets that are really the centerpiece of their net worth, whatever those may be. But the life insurance that they're buying, whether it's in an ILET or in a special purpose LLC, or sometimes even in their own names, is a big part of their estate plan. And the art and the science of the underwriting of a premium finance loan is taking the moment in time where we are today and trying to look forward and forecast 10, 15, 20 years about what will it look like in the future for that client. Do they have an ability at some point in the future, an undetermined time in the future, to repay the loan, maybe by having a liquidity event? Could they possibly sell some of the real estate and repay the loan? Could they sell the family business at an advantageous time for them and repay the loan? All of these things are in our minds as we're underwriting and improving these loans. And because if we make one of these loans and it turns out that it doesn't work and that policy has to be surrendered, then there's no way that client could ever go back and get that life insurance policy again. Not the same life insurance policy that they had originally financed. And that's important, because if that life insurance policy is gone and 5, 7, 9, 10 years have gone down the road, you can't go back and get that same life insurance policy again. You could go get another life insurance policy, maybe, if their health and status hasn't changed, but it's going to be more expensive. So a lot of care and due diligence needs to be done on the front end when putting one of these loans together to make sure that it will stand the test of time. And I've told Kathy and Gonzalo this before, and this may strike you as an interesting thing for a guy in my position whose job is to grow the premium finance business at U.S. Bank. It may sound odd for you to hear me say this, but I will say this, and that is premium finance is not for everyone. Okay, it is for the types of clients who understand the risks involved. When you leverage any asset that you have, when you introduce debt, it changes the dynamic. And so having a firm understanding of what that looks like and the types of risks that could come into play, they need to be understood and recognized. And the underwriting and the planning needs to recognize that, things like interest rates may rise over time. And we have ways to mitigate that. And I'm going to talk about that in just a second. What if the borrower doesn't want to renew the loan? What if the bank gets out of that type of lending? And none of those things I expect to happen, but 20 years from now, things could change. So what if the estate and gift taxes change? What if the collateral that they pledge, what if the value drops in it? What if they pledge liquid assets like an investment account and the bottom falls out of the market again through no fault of anyone on this call, right? So these are things that should be addressed with the clients when these loans are being put together. And I'm not pointing these things out because I want to scare anyone with those. I just want you to think, I want to pass this along as the things that we as a bank think about when we're underwriting, a lot of the stress testing that goes on. So let's get into some specifics now. And back to the question that Kathy asked earlier. So I've got a case study here for you. And these are real live numbers, by the way. This is a family that had an opportunity that we looked at, and this was the case design. So they had annual premiums that started at that. It was a kind of a unique structure that they came up with, but the structure initially called for about $1.6 million in borrowing, and then it stepped down over time to year 8, where there was only $102,000. And by the way, it was 2 policies involved. So I want to walk you through what all of this means. So the annual premiums are here. This other financing column that you see, that is the cost for outside counsel to produce the loan documents that we have our clients sign. U.S. Bank does not charge any origination fees for premium finance lending. The only thing we pass along is the hard costs that come to the bank, and that is that's where you see this other financing. And so what we were proposing was a loan, and then a 12-month loan that we renew every year. And you see here, we're expecting to keep renewing this loan for 15 years, and I would have run this out to 30 years if the page was larger. So here you see, so that gives you your total principal here. You see here, total interest is blank. And the reason that that's blank is it's because the client is paying their interest out of pocket, meaning it's not being added to the loan. Now, let's talk about interest rates. Let's pause right there on this column and talk about interest rates. So U.S. Bank offers loans that use 30-day LIBOR as our index, and then we add a credit spread above that. And 30-day LIBOR, in case you're wondering right now, is about 12.5 basis points, about 0.125%. And the types of spreads that we're adding onto our loans for a loan that is 1 year is typically between 1.25 and 1.4% above that 30-day LIBOR. If we do a 3-year loan, we're adding 1.5 to 1.65% above LIBOR. And if we do a 5-year loan, then normally it's about 1.85 to 2.05% above 30-day LIBOR. And that's all client specific. Every client, no two clients are exactly the same. So you may say, well, why would one have one rate and one have the other? Because not every client is exactly the same, and it's all about their financial standing and their design and their case. So, these are, like I said, these are all custom built, custom designed solutions that we're providing. The longest maturity of a loan that we'll do is 5 years. But I will tell you that the expectation is that at the end of whatever maturity period we have, whether it's 1, 3, or 5 years, our expectation is that we're going to renew the loan and renew it and renew it, and that we'll probably have about 20 years or more invested in that loan by the time it's all said and done. So there are ways, though, and so I talked about the interest rates. There are also ways through the use of an interest rate hedging product that the bank has, where we can offer a swap, a credit swap. And what that does is it provides a way to fix the interest rate for up to 10 years. Even though we're renewing the loan every 1, 3, or 5 years through the use of what's called a credit swap, and that's called a derivative product for those of you who have heard of some of this before, where we can fix the interest rate on the loan for up to 10 years. Other tools in the toolkit include an interest rate cap, where we can provide, it's not a fixed rate. The rate can still float at today's low interest rates, but we can provide an interest rate cap. There's a premium that is paid for that, a one-time premium that is paid, and that can be added to the loan. So there are also interest rate collars, where you set a floor and you set a ceiling. So there are a lot of ways to mitigate and hedge interest rate risk through the use of hedging products, like I mentioned, with caps and swaps and collars. So a lot of clients right now, just as we sit here right this minute, a lot of clients are electing to merely float because the rates are so low that they're happy with where they are, and they recognize in their estimate and judgment that it will probably be a few years before rates rise. I'm not going to tell you that that's good advice or bad advice. You know, we all read and hear the same prognosticators talk about that. It does appear that rates will remain low for the next few years at least, but you know, that's a conversation to have with your client and with us to talk about, okay, should we hedge an interest rate? You know, should we provide some kind of a hedging product? And we've got all kinds of solutions that we provide, at least the options on just about every deal we do. So I'm going to move over here to the primary, you see here, total primary cash surrender value. And this was taken directly from the illustrations, and I want to talk about that. So when we get illustrations, we ask that they be run for an IUL at 3.5%. We don't use the guaranteed numbers, nor do we use the AG 49 numbers. We kind of shoot the middle ground there, and we ask for an illustration that's run at 3.5%. And we use that illustration to base our collateral number on, and I'm going to talk about that more in just a second. For a whole life product, what we ask for is we ask for an illustration that is run at the current dividend minus 50 basis points. And that's what we use to set our collateral is that. I will also ask you for an illustration at current dividend minus 200 basis points, but we do that only because in a compressed and falling dividend rate environment, we are interested in our underwriting in knowing what that could look like if those rates fall. Excuse me. But we're not using that to set our collateral. Only the excuse me, the dividend minus 50 basis point are we using for that. So we take those illustrations in this column you see here, total primary cash surrender value, and we will lend 95% of that cash surrender value from those illustrations that I just described. Okay? And the next column you see here is the prevailing gap between the loan amount. Here's the loan amount, 1.68 million, 1.678 million, and the amount that we can lend, 1.175 million. That leaves what we call a gap, the gap collateral. And Kathy, to your earlier question and the question that was asked, what will U.S. Bank accept for that gap collateral? The answer is that we have one of three things that we can accept. One is cash that is here in our bank. Number two is an investment account that is here in our bank. Or number three is other in-force life insurance policies. And I'm going to touch on that for just a second, because think about your client base that you've built up over time. All of the clients you've sold life insurance policies to in the past who probably need more life insurance now, right? You may have sold someone a policy 10 or 15 or 20 years ago, and their business or their life situations changed to the point where they now need a lot more life insurance. That policy that you may have put in force for them a long time ago could work very well to cover that gap collateral need that you see here in this column here, the $503,000 number. This $503,000 number that you see here, that assumes that cash is pledged. That's 100% advance rate on that asset that's being put in the bank. Over here you see I've got a 70% advance rate, and that would be if instead of pledging cash, they decided that they wanted to pledge an investment account. So, and it's important to remember, okay, this is a really important point. They're not spending $718,000, they're pledging it. So they're pledging assets that they have in order to, in this case, let's say they had $718,000 worth of investable assets in an investment account. They're pledging that so that we will lend $1.678 million. That's kind of the magic here, right? They're not spending money, they're paying interest, but they're not spending. This money is not gone that they've pledged. And now this design here, I wanted to show you, we've run it all the way out to 15 years. So keeping in mind that this is using these were IULs at 3.5%. So most years will be well above that. Some years could be below, but in a 3.5% environment, let's say that policy returned 3.5% every single year. This would be the collateral need over time. Now, we're happy to model this for you any way that you would like. We'll model it for you with assuming higher returns, illustrations with higher returns. But in terms of the underwriting that we do, we're going to use that 3.5%. That's our requirement for our underwriting. And also, the types of information that we gather for underwriting is exactly what you would expect. It's a personal financial statement. It is the tax returns and the K-1s for the borrower, and it is their liquidity statements, and then the insurance illustrations. Those are key things that are needed for every type of every loan that we underwrite, rather. Now, I mentioned earlier that premium finance, the insurance premium finance at U.S. Bank is not a free insurance play, and I want to show you this. On the next slide that I'm about to flip to, I want to compare something for you. So this model that we have right here assumes that the clients are paying interest out of pocket. And I would tell you that if you want to help your clients design a loan that will stand the test of time, having them pay their interest out of pocket is the way to do it, because you don't artificially inflate the amount that they're borrowing beyond just what they need for their premiums to be paid. Now on this next page, I'm going to show you. Notice the potential need for gap collateral in year 15. is about $4.4 million. And that's just the amount of collateral that is being pledged. Again, remember, they're not spending that money out of pocket. It's just the collateral that's being pledged. Or say $6.3 million if they were going to pledge liquid assets. Look at what it is if they want to capitalize the interest. That number jumps from $6.3 million to $12.4 million. See, in this total interest column, you will see here that this assumes that the interest is being added to the loan. Now, does U.S. Bank have loans where we've capitalized interest? The answer to that is yes. And you may say, well, why would you do it? Why would you capitalize interest? The answer is that those clients that are capitalizing interest, keeping in mind what I said earlier, that this is a custom design and a custom build, those clients are very liquid. And I mean very liquid, and that's a subjective term. There's not a metric to say that they need to have X amount of liquidity. But in our underwriting, we're making a subjective decision that they have sufficient liquidity that they could pledge that type of liquidity down the road if it became necessary. Again, I'll say it again. This assumes the 3.5% return. So it's unlikely that this is going to ever play out exactly this way. And that's where I mentioned earlier that this is a little bit where the art and the science of underwriting come together, because there will be years where it's far above 3.5%. It may hit the cap, right? There may be a few years where it's a zero. You just never know. So what we're trying to do is build a loan that will stand the test of time, and not make our clients put our clients in a spot. And when I say our clients, I mean at this point our mutual clients, right? These are clients that you have gone out and pitched the idea of premium finance and brought U.S. Bank to the table to discuss. They're our mutual client. We want them to be safe and secure in what it is that they do. And I'm pleased to report to you that U.S. Bank has never had to surrender a policy for a client whose loan went bad. We have been brought in many times to refinance other lenders' loans that really weren't structured in an appropriate way, or we've also been brought in when a new insurance producer came in and had to rescue some bad underwriting, a bad policy or a bad policy solution that was put in place. So, over the course of the last 24 months, U.S. Bank has done a lot of refinancing of existing premium finance loans, with sometimes including new policies. Sometimes we're merely refinancing the existing debt and making a loan that is stronger and better suited for that client's needs. So I'm not going to sit here and cast aspersions at any bank in the premium finance marketplace. Each bank has their own way of underwriting it, but I will tell you that, and I'm not ashamed of this comment or afraid to say it. The initial underwriting for a premium finance loan should be thorough, and U.S. Banks is thorough. I'm not going to hide from that, because again, we're trying to put something together for your client, whom you have probably spent years investing time and energy into and bringing to the table for a transaction like this. We need to put together something that reflects the very best of what can happen for them over the course of a long period of time. So that's always in the back of our mind as we're doing these our analysis and our underwriting is, what could go wrong with one of these loans? What happens if instead of a 3.5% return on the cash surrender value, what happens if it's zero for 2 years in a row or 3 years in a row? That's highly unlikely, but we may stress it that way. And we also try to forecast what would happen if interest rates rise. That's why we talk about interest rate hedging with most loans that we do. Not all clients want that. Some clients are pretty amenable to the interest rate risk. They make their own calculations about where they think rates would be over time. So we're a part of providing that solution. We're not dictating. We're just all a part of the same team trying to put together the best loan and best structure possible for our clients. And it is very much a hand-in-hand discussion. It's not adversarial. It's not argumentative. It's, hey, let's do it this way. Let's talk about this with the client or with the producer. Let's all be in the same arena with the same goal in mind about putting together a safe loan that will stand the test of time. So, Kathy, I think I'll pause there for a minute. We're at 45 minutes past the hour, and I wanted to stop at 45 minutes past the hour and see if there were questions or other discussion points or things that we should talk about with the group.
Taylor, thank you. It is a good place to pause. We had a couple more questions come in. One was, must the liquid assets pledged for collateral be cited at U.S. Bank versus some other institution or facility?
So the short answer to that is yes. Now let me provide a little nuance to that answer. The U.S. Bank has we have a relationship with Fidelity, where on their institutional platform with Fidelity only, and trust me, I wish that it was with Schwab and TD Ameritrade and everyone else, but the bank only has that relationship with Fidelity, where if the assets are in their institutional platform, and what I mean by that is typically that means they have outside investors or outside investment management for their funds, the assets can stay in place at Fidelity. Otherwise, they do need to be in an account at U.S. Bank. And let me explain why I think it's important. This is an important distinction. This is not, and I repeat, this is not a play by U.S. Bank to try to snag assets under management or asset under management fees. In fact, most of the time when clients bring their assets over, they don't go into a managed account where the bank is charging a fee. The reason that we need them in an account here at U.S. Bank is for monitoring purposes. It's because that's the only way that we can get a real-time valuation on the assets that are collateral for our loans. About 10 or 12 years ago, let's call it pre-Great Recession, U.S. Bank used to have a lot of loans that were secured by assets held at third party, like Merrill Lynch or Schwab or something like that. And what would happen is we would get our monthly statements that showed the value of our accounts, and sometimes the values had fallen during that month where the loans were out of margin and required a collateral call. And as we all saw in some of the bad times back in the old days, sometimes they fell really far and the clients weren't able to answer those collateral calls. So us having a real-time monitoring is a part of our loan policy that changed after the Great Recession, and that's why that requirement exists. So I'm glad that question was asked so I could have a chance to address it, because it's important that you hear and understand why we do anything. And I think the key to the game, the key to anything, is full transparency in everything we do. There's no question that's off limits, Kathy.
Some additional questions, Taylor. U.S. Bank is not for the faint of heart. There are minimum loan requirements that are that need to be factored in when you first look to U.S. Bank. So if you could talk about minimum loan requirements, additional fees, like is there any kind of gotcha that somebody needs to be concerned about? And what's the time frame that it's going to take to close a transaction? And is U.S. Bank looking to go on the application for part of the insurance commission? So maybe you can quickly focus on all of those questions.
Yep, let's break those down. And Kathy, if I failed to address any of them, please redirect me. Okay, so there are no gotcha fees. The only fees that the bank that are associated with the premium finance loan is the pass along of the outside counsel fee that U.S. Bank is charged by the outside counsel who draws up our documents. And we have an arrangement with several of the best firms in the country at premium finance lending, where due to our volume, we have pre-negotiated rates with them for, you saw in the case study, the $5,500 at origination and then $2,500 for loan amendment. So there's no origination fee. There's no U.S. Bank fee just for, the pleasure of letting us lend you money. We charge you a fee. No, we don't do that. Second was, Kathy, help me with the second. I'm thinking more about the third right now. So let me jump to that third one. And that was, is there the requirements, right? So it is I mentioned this earlier in passing, and that is the information that we gather for underwriting is 3 years of tax returns, current liquidity statements for the borrowers, their personal financial statement, and then these insurance illustrations that we talked about. The typical turnaround time for a loan from U.S. Bank is about 4 to 6 weeks. And we're always trying to hone that and craft that and make that a shorter and shorter time. I will tell you right now is a period of unprecedented demand. It's good to be an insurance premium finance lender right now because there's a lot of recognition for the need for this product and as well as rates being as low as they are. There's no question that helps with the demand for these. I'd like to be at about 3 or 4 weeks, and we're working our way there. But right now, just full disclosure, it's about 4 to 6 weeks from the time that we have a complete package. And that's another thing. If you want to help one of these transactions go smoothly, present the bank with a complete package of the information, not like 1 or 2 years tax returns, and then in your mind you might be thinking, well, the bank doesn't need that, so I'm not going to go get it. No, we've whittled that list down to exactly what is required. There are things that we have taken off the list over time that were superfluous or not necessary, but we've whittled this thing down now to what we absolutely have to have. And so submissions of incomplete packages, it starts a process that's really not very fun for anyone. It's not fun for the client or for you, the advisor, or for the bank, where we're constantly going back and forth and asking for things. So if you want to help a process and help the process and help a deal go smoothly, make sure you're submitting a complete package when it's time.
What about commissions?
Great question. No, U.S. Bank is not on the application. In fact, and this is an important point, and I'm glad that the question came up. U.S. Bank will not finance a life insurance policy that it sells, meaning that we're on the application for. As everyone on this call probably knows, U.S. Bank does sell life insurance, but we are not here to compete with you for life insurance sales. In fact, like I said, if someone at U.S. Bank sells a life insurance policy, I will not be financing it. And I'm not, by the way, I'm not licensed to sell life insurance. I'm not looking to sell life insurance. This is not a means for us to gather a lot of confidential information about your clients and then try to come around the back door on you. That's not what any of this is. This is a relationship business that we're in, where we intend to have relationships with the clients and with you, frankly, the advisors, for a long, long time to come. And that means treating people like we would like to be treated. But specifically, no, U.S. Bank is not going to be on the application at all.
I've spoken with some advisors who, they drill down on the interest rate, and, your interest rate, which is based on 30-day LIBOR, is extremely competitive. What happens if we move away from LIBOR? And how is that going to potentially impact the interest rate component to the U.S. Bank loan?
Great question, because U.S. Bank, just like every other bank who offers LIBOR-based loans, is going to move away from LIBOR at some point in the future. In fact, some banks have begun already, and I think U.S. Bank by the end of 2021 will have made that transition. We're working on our plans now. We are, I'm going to tell you what is most likely, and by most likely, I say about 99% sure this is going to happen, but it hasn't been officially announced yet. We're going to end up, I think, with using SOFR, S-O-F-R, Secured Overnight Funding Rate, instead of LIBOR as the index. And it'll be it will look and feel just the same to the clients as what we do now. And what I mean by that is there's an index. It will go for, instead of being 30-day LIBOR, it will be SOFR. And then we'll add a credit spread above that. At the end of the day, what we are trying to accomplish, what we will accomplish through the transition from LIBOR to SOFR is, at the end of the day, what is most important is what rate is the client paying, right? Forget about what index it is. The spread is important, but I would not lock myself into this mentality of, well, if you use prime as an index or LIBOR as an index or SOFR as an index, and then the spread above that, I wouldn't get locked into that. What I would be very concerned about, and what we are concerned about, and what we're communicating with our clients and with our prospects is, at the end of the day, what matters the most is what rate is the client paying, right? What does 30-day LIBOR plus 1.5 mean in relation to SOFR, plus some spread? You want those numbers to be about the same at the end of the day. So there will be a transition to SOFR for U.S. Bank at some point, most likely in 2021, but it will be a seamless look for the clients where there's merely a different index that's attached.
We had another question, thank you, that came in asking you to talk about other potential exit strategies for a loan other than death.
Yep. So that's a great question and something that I didn't spend a lot of time on earlier. So we've seen designs where in 12 or 14 years, we see exit strategies built into the life insurance policy itself, right? A withdrawal maybe to basis or withdrawal from the policy to repay the loan. We see that. We don't really underwrite to that, but we know that that is a common way that sometimes the loans can be repaid, is that there will be a withdrawal from the policy, pay off the loan, and then there will still be a residual life insurance benefit that remains. And maybe the client's need for that life insurance changes after 10 or 12 or 14 years or whatever it is. So that's one strategy. The other is, and I keep coming back to the art versus the science of underwriting, and that is that what we're trying to do is we're trying to look and say, is it reasonable to assume at this very moment in time, on February 17th, 2021, is it reasonable to assume that in the next 15 or 20 or 25 years that client could, and I emphasize could, recognize a liquidity event where they sell their business, or they sell some real estate, or they do liquidate other holdings and repay the loan. As long as they maintain their eligibility to borrow, and most of our clients, frankly, are not renewal risks. They're not loan renewal risks. When we underwrite them up front, we're underwriting them for the test of time. And like I said, knock on wood, we've never had one go bad. So what we're trying to do is look into the future and say, okay, other than dying, what assets do they have? What capacity do they have? What cash flow do they have? And that's what we use to underwrite. So we're in our analysis and our underwriting, we're looking at their overall financial standing. Is their debt excessive compared to the assets they have? Do they have the kind of cash flow, or could they have the kind of cash flow that could be needed to pay interest payments into the future? So there's a lot of analysis and a lot of discussion that goes on around that very point. That's a great question that was asked.
Taylor, we've had a number of additional questions come in, and they're all really good questions. So, a short one regarding the collateral. Will you accept a letter of credit? And combined with that, two-part. Can commercial real estate be used as collateral? So let's do part one, a letter of credit. Part two, commercial real estate.
Yeah, so the answer to part one and part two is no. And again, full transparency here, okay? U.S. Bank used to accept letters of credit for outside collateral, and the fact that we don't now where we used to probably tells you that something went wrong, and something did go wrong, and let me tell you how that happened. So letters of credit are they're pledged to the bank by another bank, which is great, right? The bank then has, say JP Morgan or some other bank on the hook for that piece of collateral. But letters of credit are generally speaking renewed every 12 to 18 months. And sometimes letters of credit are not renewed. And that puts the client in a precarious situation where they have no other means to pledge the type of collateral that's needed for these loans. Because these loans are liquid asset secured loans, which gives the bank a favorable capital rating, which allows us to charge those competitive rates that you mentioned there, Kathy. So bringing in any other type of collateral that's not a liquid type of collateral removes it from that bucket of liquid asset secured loans and completely changes the calculus and the calculation. And U.S. Bank, frankly, just does not make those types of loans. Now, for commercial real estate, if the client has commercial real estate, we have done this before though, where we will make them a commercial real estate loan to raise liquidity that can be used for the gap collateral need. So there are many ways to skin a cat, as they say, and so we have loaned clients money on terms that are more appropriate for a commercial real estate loan, because commercial real estate loans need to have principal and interest repayment, whereas premium finance loans are only interest payments. So there are ways to use commercial real estate and leverage it to your favor for a premium finance transaction, but we don't take a pledge directly. It's a two-step process to get that part done.
Thank you. Another question that we have not covered, are there any prepayment penalties on the loan? And then a second part to that question was, could an individual pay an amount which would be greater than the initial interest owed on the loan each year in an attempted annual buy down, for lack of a better way to describe it? So contributing a flat,
Yep.
if the interest, let's say the interest is $50,000 and the client wants to pay 75.
Absolutely. So the answer to the first question is no. There are no prepayment penalties on these loans. Now I'm going to put an asterisk next to that and say, though, if there is an interest rate hedge that is used, an interest rate swap or an interest rate collar, that's a separate contract, and they could come with their own prepayment risk. But the insurance premium finance loan itself, the floating interest rate insurance premium finance loan, does not have prepayment penalties. And furthermore, to the person who asked the question about if interest is $50,000, can the client pay 75 or 100 or some other number? The answer is absolutely yes. Absolutely yes.
You just mentioned that that a cap is a separate contract. And I have come to you in the past and said an advisor that we're working with is looking for a cap, and you tell me, give me a couple days. So can you explain the timing on that, so we can manage expectations, and why obtaining that sort of information from US Bank is a little bit more labor intensive than just getting a premium financing loan illustration from your department?
You bet. So the reason so what Kathy's talking about is, and when we have worked with her in the past, and we've talked about interest rate hedges, we'll talk about what the client might be looking for. And a lot of times what we find is that the client doesn't necessarily even know what's available. So we'll come back with the full suite of options so that the client can be very well informed about what we have to offer. Now, I mentioned that it's custom. So every single bit of this is a custom build, especially on the interest rate hedge, on that derivative product that we're talking about, whether it's a swap or a collar or an interest rate cap, because everything is flexible. And what I mean by that is you don't have to put a swap or a cap on the full amount of the loan. You can do part of it. You can do it for 3 or 5 or 7 or 10 years. In an interest rate cap situation, you get to choose the cap that you want based on how much you're willing to pay for it. So there are literally, and this is not an exaggeration, there are literally about a dozen variables that go into calculating this. And it is a manual process to figure out what the price of those, what the price of the cap would be, or what interest rate the swap would be. It's a very manual process where that derivatives team that we have, they're called the derivative products group. They have to sit down and manually calculate what all that is based on the amount of the premiums and the term that we're looking for. So you're right, Kathy. That's not something that we're going to have in 10 or 15 minutes. It takes a day or two to put that together based on their volume. But I think you would agree, Kathy, it's well worth it, because I think a lot of times we're showing clients things that they haven't even necessarily thought of.
Absolutely. Another question that came in: if the cash value in the policy satisfies the collateral requirement, will there be any additional collateral required? And also, is a personal guarantee on the loan required?
So those are two excellent questions as well. So once the cash surrender value exceeds the loan amount, then no, there is no need for additional collateral to be pledged. Now, we do have clients that over time they may say to us, what could I do to get a better interest rate? And this is no great secret to anybody, right? The larger the relationship that the bank has with that client, the better their interest rate can be served, the lower their interest rate can be. So if they want to keep money here, deposit it or whatever, and it could influence the interest rate that they're paying. But to specifically answer that question, no. Once the cash surrender value exceeds it, then absolutely not. There's no need to have the additional collateral pledged. And the second part of that question, Kathy, was?
personal guarantee?
So the vast majority of our loans do not have a personal guarantee. Most of our loans are made to ILITs, irrevocable life insurance trusts, and there is, the clients are doing that very intentionally, right? They're drawing up these estate planning entities to keep the life insurance proceeds out of their estate. So we're very careful to not pierce the veil, as they say, and do anything that might draw the life insurance proceeds into the estate. And if you ask enough advisors or enough attorneys, you get lots of different answers on this. Some will say it's no big deal. A personal guarantee is no problem. You're not going to pierce the veil. Some will adamantly tell you're running a risk with the IRS. In these transactions, that's not a risk that anybody should be undertaking. So we underwrite back to the individuals, but we don't necessarily require them to personally guarantee the loans.
A question that had come in earlier on in the presentation, I think is a good question just to share with everyone. And the advisor has since left the meeting, and we'll circle back around with him. But the question was, he had two clients looking to use premium finance for an additional wealth accumulation strategy to round out their portfolio. Is that something that is appropriate? Is that an appropriate use of premium financing?
Sure. So at U.S. Bank, it is not the type of loan that we would make. Now, I want to be clear about this. That does not mean that premium finance is inappropriate for that. It's just not in the U.S. Bank swim lane. You've heard me mention the swim lane today, right? And again, our swim lane is lending to individuals and families to effect a wealth and estate transfer. That's our mandate. That's where we are in this space. There are other banks out there, though, that will do lending for a wealth accumulation or an executive benefit or something. There are other, I don't need to tell anyone on this call, there are many, many other reasons to own life insurance besides just the death benefit. But for U.S. Bank, our place is the wealth and estate transfer that comes from the death benefit. So it can be done. To answer that gentleman's question, it can be done. It's just not something that U.S. Bank does.
Okay. We had another question that came in, which was why you had mentioned that U.S. Bank will not finance premiums for a policy that it sells, and the question was why.
Because I talked earlier about building loans that are safe and secure, and there are things that no matter how much we try to mitigate risk, there are things that could be beyond any of our control, right? The performance of the policy or what interest rates do. And what we're trying to do is we're trying to remove the risk at U.S. Bank that maybe an overzealous insurance agent might put a client into something that's not in his or her best interest just to get that sale done and just make it just a little too convenient and a little too easy for them to pay for that by doing a premium finance transaction. So there's some risk mitigation in that policy of ours. And frankly, I agree with it. There's enough business out there for us to make premium finance loans without introducing U.S. Bank as someone trying to sell and compete with everyone on this call.
Okay, I know that you have a hard stop in a couple minutes, Taylor. We have just one or two more questions, and if anybody has any additional questions, please type them in and we'll try and get to them, or otherwise we will see if we can answer them offline. One question was, has it been your experience that U.S. Bank will go after other assets, for example, assets under management, pension plans, etc.? This advisor referred a $4 million loan and has had to constantly deal with requests from a platinum banking division to move client assets.
So no, the answer to that is no. And it all comes down to an understanding of, what's possible and what's on the table. And if the advisor says to us, no, that's not on the table, then that's the end of the discussion. It should be the end of the discussion. It is not our goal to try to come, like I said, and come around the back door on the advisors. And let's talk about it from a practical standpoint, right? It's what we're doing here at US Bank with our premium finance team is we're trying to build long-lasting relationships with not only the clients, but also the advisors as well. So treating our advisors poorly is not a recipe for continued success, and so it's not something that we condone or certainly not as a policy matter do.
Okay. I do not see any other questions. Before I wrap this up, Gonzalo, do you have anything else that you would like to ask or add, or can you see, did I miss any?
No, I think you're good, Kathy. I appreciate you monitoring this, and I'm very grateful for all the people that stayed on the line until 10 minutes past 5. So good job, Taylor. Thank you for your time this afternoon.
Terrific.
Well, and
okay.
and thank you. And I will end where I began, and that is first of all, thank you, Gonzalo and Ed and Kathy and Dennis for having me. I love the interactions that I have with your team. Your team is always very thoughtful about the designs and the way you care for your clients and the way you care for your advisors. And again, not getting paid to say that. It's just my observation from the outside looking in. And so for those of you who may be on this call that have not worked with Kathy's team before, you should be. And if there's any way that we can help you at US Bank, let's work back through the AgencyONE team, and we're here for you. So thank you very much for having me.
And I'll take it from here, Taylor. Thank you so much. That was terrific. As Taylor said, if you have any questions or would like some additional information, please reach out to myself, Gonzalo, Ed, or Dennis, and we will be happy to help you. Now, what's next? On Wednesday, March 3rd at 4 o'clock Eastern Time, we are hosting an underwriting webinar. COVID has played havoc with underwriting requirements, which seem to be changing daily. Our featured speakers will be my partner and head of underwriting operations at AgencyONE, Dennis Bartos, our VP of underwriting, Jessica Karakoff, and also Julie Melendez, another underwriter that rounds out the team. A few times a year, we gather the AgencyONE underwriting department to present information to you, and these webinars have proven to be very informative, useful to your practice, and entertaining. This is the first underwriting webinar for 2021, and we hope you will join us. Also, I'm really excited to announce that on Thursday, March 18th at 4 o'clock Eastern Time, we are going to be hosting an economic update with Anirban Basu. Dr. Basu is going to present current economic data and analysis, juxtaposing the pre-pandemic and pandemic world, and then offer a forecast for the post-pandemic environment. For those of you that missed the economic update that Dr. Basu provided in 2020, he has a real love for J.R. Tolkien and the Lord of the Rings. And now that we are almost 1 year into this COVID pandemic, I am sure that we are going to see many comparisons. A group of heroes that set forth to save the world from consummate evil. What did Tolkien know that we do not? Please mark your calendars. Also, many of you have already been invited to participate in a focused study group-like webinar tutorial that AgencyONE is hosting. The first of these webinars is focusing on IUL products. We have already had 3 of these smaller study group type webinars, the most recent ending just prior to the beginning of this webinar, and there is still availability for 2 additional IUL webinars on February 23rd and March 4th. We have limited attendance in these small webinars to no more than 4 advisors, and this focused approach has proven to be very effective. Additional invitations to these webinars are being emailed tomorrow, so if you are interested, please register. If the date that you are considering has already filled up, or if you would prefer a different date and time, please reach out to me or Gonzalo or Lisa, and we will work with you in your office to arrange a date and time that is more convenient for your schedule. Those are my closing announcements for today. Thank you for joining us. If you have any questions or would like additional information, please reach out to me, Gonzalo, or Ed or Dennis, and we hope that you will join us again on Wednesday, March 3rd for the AgencyONE underwriting update. Thank you so much. That's it. Bye.